Steve Lentz here with the Inside Wire here at Discover Options. It is December 5th, 2017. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Welcome, everyone. Thanks, Brian, for joining us live, and Jim as well. I've been getting some inquiries regarding dividends, and in particular some option strategies surrounding dividends. And so I've been starting to do some research, and I wanted to start a little series here on dividends. And today, this is just a primer. This is just a primer on dividends and the relationship with option prices. And then later we'll get more detailed as time goes on, and I do more research along these lines, in particular in relation to one of our students that's interested in this. And it got me kind of thinking along these lines. And there's great literature out there, and we'll get to that in a second. But so today we're just going to cover some very, very basics. All right. In particular, we'll look at some important dates and their meanings, and then we'll look at the impact of dividends on option prices. In particular, regarding the ex-dividends dates. All right. So, and then in the future, we'll just reference these slides and rip through them real quickly as we get on to further concepts. But today, this is all we're going to cover, and I'll take some time at it and expound on these a bit. All right. So we start out with important dates. And so, and this is from, there's two great resources. I'll mention them later, but dividend.com and Investopedia do a great job of explaining dividends, their impact on option prices, dates, and from every which angle. And there's you could Google the topic and get just a ton of stuff out there. But I wanted just to quickly go through just give us a primer on dates and their meanings and option prices. So when a company decides to declare a dividend, the board of directors establishes a record date. That's step one. All right. This is a date when a person must be on the company's record as a shareholder to receive the dividend payment. Okay, so a company does not go out and declare an ex-dividend date. Okay, they first establish what the dividend level is going to be, and then the record date. All right, once the record date is set, the ex-dividend date is set then, according to the rules of the stock exchange on which the stock is traded. Now, interestingly, that's changed here this last year. So let's go take a look at this. Just as that's changed just this year in terms of the exchanges and the rules that they use. And so this is called T+2. It used to be T+3. The notion is, is that when you buy a stock or sell a stock, that trade does not settle for 2 days. It used to be 3 days. And for a long, long time, it was 3 days. But it's now 2 days, and you could see this coming out on the FINRA website back in September of 2017, just 3 months ago. All right, November, December. Yeah, September, October, November, 3 months. So this has been in place basically a little over 3 months now. And what that means is this. Let's just take a look at this as an example here from Apple. And Vanguard has an interesting little historical ex-dividend date tool. I could not access it from their website, from personal.vanguard.com. I Googled it, and it gave me a backdoor way to get in here. And it's just a wonderful little tool. You type in the symbol, and then it gives you years of historical dividend levels and the dates of those dividends, the historical ex-dividend dates, etc. So you could go back and look at what the ex-dividend date was, the announcement date, the record date, the payable, and the actual dividend amount. So let's just take Apple when they announced on November 3rd that they were going to pay out a dividend on the 16th, and the record date was the 13th. Okay, so let's take that. They come out with an announcement that they're going to keep their dividend the same at 63 cents a share. They're saying that the record date is November 13th. So that's the decision they make. All right, is that they're going to, this is a little calendar. So on the 3rd of November, on a Friday, they announced what they were going to do in terms of a record date and the dividend level. And that's what they announced. The record date was on the 13th, and in this case it was 63 cents. Now what happens? Okay, now what happens is the exchanges take note of that, okay, and they back it up 2 days, because remember, it takes 2 days for trades to settle. 2 days, T+2, that's the new FINRA rules. So we back up 2 trading days so that Thursday, the 9th, is the last day that you could buy Apple stock and have it include the dividends, or cum dividend, as they say. Cum dividend means with dividend. Okay, ex-dividend means without dividend. And so then, by default then, if this is the last day, because you have 2 days to settle, the very next day would be ex-dividend date, without dividend. Okay, and that's ex-div, as they call it, right there. So if you cannot buy shares on the 10th of November and be included in that dividend that was announced. Okay, if you didn't get in before the close on the 9th, you're done. You cannot get in on that dividend that was announced. You have to do it before, okay, the close of Thursday the 9th, because when the open of the 10th comes, then the stock then does not include that dividend, okay? Now, let's just go through the definition of ex-dividend. So the ex-dividend date is the date on which all shares bought and sold no longer come attached with the right to be paid the most recently declared dividend. This is an important date for any company that has many stockholders, including those that trade on exchanges, as it makes reconciliation of who is to be paid the dividend easier. All right, it is just as important for investors, however, since you must own a stock before the ex-dividend date in order to receive the next scheduled dividend. Okay, just to be clear. So, because this is very important that we understand what the ex-div means, what the record date, etc. So, how does a stock price typically behave amidst all this? Okay, so you're tooling along. Let's say it's the end of October. You come into the beginning of November, and then boom, all of a sudden, Apple issues a press release before the open on November 3rd that they're going to pay out 63 cents, and the record date for them will be November 13th. They come out with a press release before the open, and what happens then at that point? Okay, so let's go through that. On the announcement day, theoretically, okay, there's going to be an intrinsic increase by that dividend amount. Okay, and I'm going to put approximate because here's the thing: there could also be extrinsic impacts of between the market sentiment. I mean, if the market is in a bearish tailspin, then all bets are off, right? There could be company expectations, and maybe, and then the speculation on how much of the dividend was already priced into the stock price. Tons of studies done on this. You could Google it and look it up. I don't. I've been trading. I do indexes and options on indexes primarily. I'm not personally a dividend trader, but I'm just responding to some demand for it amongst our students, and so there are probably few topics as studied as the effect of dividends on stock price. There's just a world out there. I saw one study on the impact of ex-div dates on the whole Thailand stock exchange. It was just crazy, the level of research going on out there on dividends and everything, and also the increasing dividends, the dividend growth and the impact that has is another topic too. But anyway, so on announcement day, by nature, you would expect that the stock would go up by that dividend amount that's going to come out here in what, a week and a half. Okay? Now, it could be that the market was pricing that already in there, because Apple does what? I mean, they paid out 3 cents per share for several straight, cycles here. Okay, it's not, and so for them to deviate from that could be a big deal. But here it comes out 63 cents. Was it factored in or not? That's a big question. But here's what we do know that's more solid, is that when that ex-dividend date comes, all right, that dividend gets paid out, okay, by the company. And in fact, then there is an intrinsic decrease by that dividend amount. Now, it might be affected by taxes, all right? There might be some elements affecting it, but the exchanges are going to apply measures so that traders cannot game the system. That is, they're going to automatically reduce the price at the open the next, they're going to factor that in when they come in with a price at the open the next day. Also, all stops and limit orders based upon the previous day, any stops and limit orders get automatically altered by that dividend amount. All right, that way you can't have the gaming of the system by other folks coming in and taking advantage of those sitting orders sitting there without the, pre-dividend, without the benefit of getting automatically changed. So that's what happens on Ex-Div, is that the price will automatically decrease by that dividend amount, okay, give or take taxes, plus then, you're going to have the other market factors coming in as well. But at least as a starting place, the dividend is reduced from the stock price to kick things off. Now, how does that affect option prices? Let me get a sip of coffee and away we go. Just a second. So here we see a matrix of the close just prior to Ex-Div with Apple, the most recent Apple dividend. All right, and so Ex-Div was November 10th. This is the close of the 9th. And if you look carefully, you could see how the at-the-money calls have a much lower implied volatility than the at-the-money puts. There is an expectation that the market, that this stock is going to decline in price because of the dividend, and that's being reflected in the options here, where you'll have the puts having a much higher implied volatility than the calls. The calls are cheaper than the puts because of this coming up move to the downside. Now, what happens then when dividends affect this and we go to Ex-Div date right at the open? Right at the open, the stock is going to go down, or at least that will be factored in, and then that little event will have taken place, and then we would expect what to happen to the options. Okay? We would expect then that the implied volatilities for the at-the-monies would come much more closer aligned with each other. You can come down here to the bottom right, and these averages are looking at the entire matrix, of course. But that just gives you a flavor for the separation in IVs here. Now, here's the open on Ex-Div. You can see now that the call and put IVs are much closer. You can see much closer aligned like this. Okay, and let's just put these side by side. I just took a few columns, putting them side by side. So here's the close, here's the open, and here are the averages down here. Okay, you could see that the call averages actually went up and the puts dropped. There's still a little bit of a separation, but again, remember that's taking into account the whole matrix. But you can kind of see here we're looking at 15 and 3. Then you have 19 and 21. This thing pops to 18. 17 and 20. You see how they kind of snap into alignment. And of course, look at the Apple stock went down $1.14. The starting place was at 63 cents. So it looked like then you had another 51 cent on the downside. So maybe the market sentiment in total, and maybe there was a disappointment that Apple wasn't going to give more dividend. And so you had some little bit of bearishness right at the open on Apple above and beyond the dividend coming out. You see that? We would, if it were just perfectly aligned with the dividend, that would be minus 63 cents. Okay, but it's going beyond that in this particular case. And let's see, anything else? Well, and that could affect the fact that there's a little bit of bearishness could display why we're going from an 18.1 average overall IV up to 18.9. A little bit more bearishness, implied volatility gets pumped up a little bit, etc. And so that's kind of what we're seeing there. Let me show you one more example of this. And I pulled a little example from General Electric. They have a pretty healthy dividend here. Back in September, they came out with 24 cents. And you can, again, kind of take a look over here. You have the calls having lower implied volatility than the puts because we're getting ready for that downward move. You can see the separation, call IV, put IV. And then what happens then is that you would expect the stock price to go down 24 cents. It went down 10 cents, so this looks like it went down, it went down 14 cents less than the dividend was. And so I guess there was some bullishness built into there. But you can see how things snapped into place. The call, at the money call and puts, they're much closer aligned now after the big move, or after dividends came out in that case. Okay. So finally, resources. If you are interested more in studying dividends, Dividend.com has fantastic information. They have a screener there as well. It's free, and it can get quite advanced. And there's just a world to explore on Dividend.com. And then in the future, other topics. As I go down this path, long-term option overlay strategies on high-yield stocks. That's for the longer-term option, strategy investors. More, longer-term campaign outlooks. And also we need to cover covered calls and early assignment on stocks with dividends. So that's a little tricky thing we want to include when we cover the notion of long-term option overlay strategies, covered calls, maybe writing puts, doing maybe a Papali type strategy with his ricochet, that kind of a thing, doing the ricochet strategy on growth stocks, or at least stocks with increasing dividends, that kind of a deal. So anyway, that's it for today. We'll keep these slides in the ringer when we come back next time for another look at dividend strategies. Any comments, questions? Okay, Brian. Okay. Are there any plans for the OptionVue model to incorporate expected future dividends received prior to expiration? That would eliminate the IV disparity between calls and puts to incorporate expected future dividends received prior to expiration. I don't know. I do know that, and you can kind of see that Len was going to work on modeling in the last release, 8.31, that was released December 1st. When you get to the end of his status report under enhancements coming soon, he talks about the pricing model and, or more accurately, the volatility skew model. I don't know that it includes dividends. I could certainly check and bring that up to him. The modified BS OPM can also be used, which accounts for the present value of future expected paid before expirations. I believe, Brian, that the Yates model includes the possibility of early exercise, but a modified Black-Scholes. So I believe that the Yates model is a modified Black-Scholes for the possibility of early exercise, but I don't know that, and I don't think it accounts for expected future dividends received prior to expiration. Well, now, Let me think this through. Expected future dividends received prior to expiration. The only way to receive those dividends is to exercise your long calls, right? You'd have to exercise those long calls to get the dividend. Now, my understanding, and then that's one of the advantages of the Yates model, is that that did include that, the possibility of early exercise. But just an option price by itself, dividends aren't included with options. The stock price is reduced by the present of expected return. Well, true. Oh, I see. So you're saying that that should be incorporated in that. I'll bring it up to him. I'll see what he says. Makes sense, because then that would take away that disparity. I have to think that through a bit. Yep, I'll just have to give that a gander. That would eliminate, yeah, it would eliminate the IV disparity if that was included. I get it. I'll go talk to him and see. Makes sense to me. See what he says. See what Jim will weigh in on it too. Okay, Brian, thanks so much. Folks, thanks so much. I know a lot of folks watch this on the recording, and we'll talk to you later. We'll be back next time. Take care. Have a great rest of the day. Bye.